Hello, I'm Professor Brian Boucher. Welcome back. Now that we have the basics of time value of money under our belt, we're going to apply those to accounting for various types of long-term liabilities, like bank debt, mortgages, leases, and bonds. A lot of bonds. Let's get started.
So we're going to start our look at long-term liabilities by contrasting them to current liabilities. Current liabilities are anything due within 1 year, less than 1 year. And these are pretty much most of the liabilities that we've been seeing so far in the course. So things like accounts payable and interest payable, taxes payable, wages payable. Those were all very short-term liabilities. We have to repay somebody within a couple months. Those liabilities are booked at their nominal value. In other words, how much money you owe. We don't try to figure out the present value. So for accounts payable, we don't try to figure out the present value of paying something off 2 months later. But when we talk about long-term liabilities, so liabilities due beyond 1 year, now we're going to book those liabilities at the present value of future cash payments. After we record those long-term liabilities, in some cases we continue to mark them to fair value, but in most cases that we'll talk about, they're recorded at something called amortized cost, which is you book the liability initially at present value, and then you may make adjustments based on interim cash payments or premiums or discounts, which we'll talk about later, but you don't mark it to fair value every period. So as a result, when you look at liabilities on a balance sheet, what you're oftentimes seeing is a mix of fair values and then these amortized costs, which are like old historical costs.
Now that you have made us watch 69 minutes of video about time value of money, I sure hope we will use those calculations in this video. Those were 69 minutes of my life that I will never get back again.
Oh yeah, we'll be doing time value money calculations. Not for the first few minutes of the video, but toward the end, you'll be seeing them. Don't worry.
The liabilities that we're going to focus on for most of the next two videos are different types of debt. So we're going to talk first about bank loans. This is a kind of liability where you borrow some principal up front, so maybe you borrow $1,000. You make periodic interest payments on that $1,000, and then you repay the $1,000 principal at the end of the loan. A mortgage will be something where, again, you borrow principal, so you borrow, I guess we should make it $1 million. Then you make periodic interest and principal payments over the loan period, such that by the end of the loan period, you fully paid back the principal. There's not necessarily that lump sum payment of principal at the end. And then we'll talk about corporate bonds. Corporate bonds are where a company promises to pay periodic cash flows, which we're going to call coupons, plus a lump sum at maturity, which we're going to call the principal. What the company does is offer these to the public, and then investors offer to pay the company the present value of the coupons and the principal. So that's how much cash the company raises from issuing the bond. Investors can then sell the bond to other people freely until the maturity of the bond. And there's a special case called the zero coupon bond, where the coupon payment is zero, so there's no periodic cash flows, but you just pay back a lump sum at maturity. So you borrow now, and then you pay back at maturity.
My favorite type of debt are loans from my parents. I borrow principal, make no interest payments, and make no principal payments. Will we cover the accounting for these type of loans?
No, we won't be working on accounting for parent loans. Those actually sound more like donated capital than actual liabilities.
First, let's look at how we do the accounting for the bank loan. So in this example, on January 1st, 2010, KP Incorporated is going to borrow $10,000 from a bank on a 3-year loan. The bank charges the firm 5% interest per year. So it's always helpful to look at a timeline of payments to try to figure out when we're going to get cash and pay cash, and that'll help guide the journal entries. So on January 1st, 2010, we're going to receive $10,000 cash. Then on December 31st, we're going to pay $500 of interest. The $500 is 5% of $10,000. We pay the same amount on December 31, 2011. It's the same amount because at that point we still owe $10,000. We pay 5% interest on that. And then at maturity, December 31, 2012, we pay the last interest payment plus the principal that we owe. So first, I want to do the journal entry for issuing the debt. So when we first borrow from the bank, and I'm going to throw up the pause sign and see if you can do the journal entry for first borrowing from the bank. Okay, so on January 1st, 2010, we're going to receive cash, $10,000. So we debit cash, $10,000. And we want to credit a liability for what we owe the bank. So we credit notes payable, $10,000.
Wait, you forgot to record the interest payable.
Finally, a legitimate question. So remember, we don't book interest payable until we've incurred interest expense without paying it in cash. So there's no interest payable on the day that we get the proceeds of this loan, because we could, in theory, just turn around, pay it back immediately, and not owe any interest. So interest payable and interest expense are only going to accrue over time.
Next, we need to do the journal entry for the 2 periodic interest payments. So the interest payment on December 31, 2010 and December 31, 2011. So I'll put up the pause sign and you can try to think of what those journal entries would be. Okay, so we are debiting interest expense for $500 because that's a cost of having the loan outstanding. That goes on the income statement as an expense. Credit cash for $500 because we're paying $500 cash. December 31, 2011, we make the same journal entry. We debit interest expense and we credit cash. The last journal entry that we need to do is when we repay the principal and pay that last interest payment on December 31, 2012. So I'll put up the pause sign and try to do the journal entry that we would do on December 31, 2012. Okay, so we're paying off our notes payable. To get rid of the notes payable liability, we debit notes payable $10,000, so that goes to zero. We debit interest expense because we had another $500 of interest expense for the year. And then we credit cash for $10,500, which is the total cash we're paying. Now, you could have also split this into 2 journal entries, debit interest expense $500, credit cash $500, and then debit notes payable $10,000, credit cash $10,000. Either one is okay, just as long as your debits equal your credits. Now we're going to look at accounting for a mortgage. So on January 1, 2010, KP Incorporated borrows $10,000 from a bank on a 3-year mortgage. The bank charges KP 5% interest per year on the mortgage. The required payment is $3,672 per year.
Do you know how long it takes to write $3,672 in words on a check?
A check? Wow, you are old.
Anyway, why doesn't the bank just make the payment a nice round number, like $3,700?
I'm sure the bank would be happy to give you a nice round number as a payment, but if they would be rounding up, then they're cheating you. They're charging you too much. This $3,672 is not an arbitrary number pulled out of thin air, but it actually represents a payment based on an annuity calculation. Let me show you.
So here's where we get the payment number. It's a present value calculation, and specifically it's an present value of an annuity, but in this case we actually know the present value. What's missing is the payment, because we know the present value is $10,000. That's how much we're getting now. There's no future value. There's no money that's going to change hands at the end. It's an annual payment, so we use the annual interest rate of 5% for the rate. 3 years, and it's 3. We don't know the payment. We can use Excel or a calculator or PV table to try to solve it. The payment comes up to be $3,672. Easiest way to solve this is Excel, so let me pop out to Excel and show you how to do that. So going into Excel, we hit the little function button. We look for the payment function, PMT. We put in the annual interest rate, which is 5% for 3 periods, 3 years. The present value is $10,000. There's no future value, and it's an ordinary annuity, so we hit OK. It shows us the negative. If you want to see it as positive, you put that in there, and we get $3,672. So coming back into the PowerPoint, what it's always helpful to look at when accounting for a mortgage is what's called an amortization schedule, which tracks the principal and interest payments over time. So at the end of that first year, December 31, 2010, the amount of principal that we owe is $10,000. Then we're going to make a payment on that day of $36.72. Now that payment is going towards principal and interest. So first you calculate the interest portion of the payment. You take the beginning balance, which is $10,000, times the 5% annual interest rate. And so we're owe in terms of interest for the first year is $500. So how much principal are we paying? It's the difference between $36.72 and $500 of interest, which means we're paying $31.72 of principal. So if we're paying that much principal, that means that after the payment, the ending balance in our principal, our mortgage payable, will be $68.28, which is $10,000 minus $31.72. Then at the end of 2011, the beginning balance is what we ended with last time, $68.28. We make the same payment of $36.72, but this time the interest component is less. It's calculated as the beginning balance times 5%, so it's $68.28 times 5%, which is $341. Since we're paying a little bit less interest with the same payment, we pay off more principal. That's calculated as $36.72 minus $341, so that's $33.31. And so since we're paying back that principal, the balance in the mortgage principal at the end of the year is $34.97. That's $68.28 minus $33.31 gives you $34.97. And then we get to December 31, 2012, which is the end of the mortgage. So coming in, the balance is $34.97. The interest portion is $34.97 times 5%, or $175. So we're making the same payment of $36.72, which means that the principal portion is $34.97. $36.72 minus $175. And voila, that's exactly how much principal we owe. So after we make the last payment, the principal balance is zero. So instead of paying back the principal in one lump sum at the end, we're paying back some principal every period, so that by the time we get to the end of the loan, we've paid back all the principal in addition to annual interest.
Wait. Why does the interest change each year, and why is it highest in the first year? No wonder everyone hates banks.
Now. I used to work for a bank. Some of my best friends are bankers. Let's go easy on them. So there's a rational explanation why interest is highest at the beginning and then goes down over time. Interest is always based on the balance of principal at that point in time. And what we're doing in each payment is we're not only paying interest, but we're paying down principal. As we pay down principal, then the interest charge on that principal is going to be lower. This is a natural feature of a mortgage. If you ever buy a house with a 30-year mortgage, you'll notice that almost all of your first payment goes to interest. You pay a little bit down in principal. As you pay more and more principal down over time, the interest portion of the payment drops, the principal portion increases.
Now that we've laid out the amortization schedule, we're going to go through and do the journal entries. So we can take our amortization schedule and represent it in a timeline. So on the day that we borrow from the bank for the mortgage, January 1st, we get $10,000 cash coming in. And then we're going to make our 3 payments of $36.72, which are split into interest and principal. So let me throw up the pause sign and have you try to do the journal entry on January 1, 2010, which is when the mortgage is issued to the company, so when KP borrows the money. So we're receiving cash. KP is receiving cash from the bank, so we debit cash $10,000, and we credit mortgage payable, a liability for what we owe back the bank. Then at the end of 2010, December 31, we have to make our payment. So I'm going to throw up the pause sign again and try to make the journal entry for 12/31/2010. So here we're going to reduce the principal balance in mortgage payable by $31.72, so reduce the liability with a debit. We're going to debit interest expense for $500 to represent the cost of the interest during the year, which needs to go on the income statement. And then we credit cash for the amount of the payment, $36.72. So let's try it again with the 2011 payment, and here is the pause sign. So it's going to be the same entry, different amounts. So on December 31, we're going to debit mortgage payable again for the reduction in principal, which is now $33.31. We're going to debit interest expense to recognize the interest cost in the income statement in this period, $341, and credit cash for $36.72. Last payment, 12/31/2012. Why don't you give it a shot? Again, same entry, different numbers. Debit mortgage payable to reduce the principal balance by $34.97. Debit interest expense to recognize the cost of the interest on the income statement, $175, and then credit cash for the $36.72. And at this point, the mortgage is fully paid off, so there are no more journal entries. So that's what goes on with the accounting for a mortgage, where you have this situation of equal payments, and the payments are partially for interest and partially for principal, so that by the end of the payment stream, you've paid off the loan. Now we're going to look at bonds payable, which is a very common way that companies raise money to finance their operations. So bonds payable, as we talked about a little bit at the beginning of the video, these are coupon bonds, which means that they're going to require semi-annual coupon payments. So there's going to be a payment of cash every 6 months, plus payment of the face value of the bond at maturity, so at the end of its time period. So the terminology that we're going to use with bonds are the following, and what I'm going to do in parentheses is note how they would map into our present value calculations. So the price or proceeds of the bond is what the company receives when they issue the bond to the public. That's going to be the same as the present value in a time value of money calculation. The face value or par value is the amount that the bond is going to pay at maturity. That's also going to be represented as the future value when we do time value money calculations, and you can easily remember it because face value, future value, both FV. The market interest rate or effective interest rate or yield to maturity, those are all synonyms. That's the rate R that we're going to use to calculate present values. That's what rate the investors are willing to lend money to the company at. We're going to have the coupon rate, which is stated in the bond agreement, and that's going to determine the coupon payment, which is the payment in our present value calculations, which equals the face value of the bond times the coupon rate. And then the number of periods to maturity is going to be N. And so we're going to go through examples and see how all of this works. But the key thing to remember is that bonds have semi-annual payments, which means we need to do semi-annual compounding. So we have to double the number of periods and divide the rates by 2 when we do present value calculations. So if it was a 10-year bond with a 10% interest rate, we would do 20 periods, 20 semi-annual periods at 5% per period. And the bond price is going to be equal to the present value of that face value amount or future value amount plus the present value of the stream of payments, that annuity.
Ugh, this sounds like it is going to be the most boring bond video since GoldenEye.
I actually thought A View to a Kill was much worse than GoldenEye, although the cool Duran Duran theme song sort of redeemed it. In case you're wondering what we were talking about, these are James Bond movies. You can't teach Bond accounting without having James Bond jokes. Here's another one. What is the favorite James Bond movie of all time for accountants? It's this one. Debit No.
Excuse me. I would appreciate it if you stopped with the dumb Bond jokes. I am sick and tired of always hearing dumb Bond jokes.
Did you say dumb Bond jokes? Let's move on.
Okay, so the example we're going to go through is on January 1st, 2010, KP Incorporated issues a 3-year, 5% coupon, $10,000 face value bond. Investors price the bond using an effective market interest rate of 5%, which means that KP is going to receive proceeds from the bond of $10,000. So basically, KP specifies all the terms of the bond, puts it out to the market. The investors in the market figure out the present value and then are willing to give KP $10,000 of proceeds to get that bond. Where do they get that from? Well, they do a present value calculation to get the bond price. So remember, we have to double the number of periods and divide the interest rate by 2. So the present value of the face value part, the 10,000, you calculate looking for present value. We'll have a face value or future value of 10,000. We use an interest rate of 0.025, which is half of 5%. The number of periods is 6, 3-year bond, but we double the number of periods to get semi-annual. And then there's no payment because we're just doing a face value, future value. So you'd come up with a present value of 86.23. And I'll bring this up in Excel in a little bit to show you all of this. We have to do the present value of the payment. So here we're looking for the present value. We set the future value equal to 0. We use the same semi-annual interest rate, number of semi-annual periods. The payment is $250. That's the $10,000 face value times the semi-annual rate of 2.5%. So that's where we get $250 from. If you use Excel, calculator, PV table to solve, you end up with $1377. So we add those two up, 86.23 plus 1377 to get the price of 10,000. Or if you're using Excel, you can just put in all of the elements: face value 10,000, payment 250, 6 periods 2.5% to calculate the present value, and you will also get 10,000. So let me pop out to Excel and show you all these calculations. Okay, so to price the bond, there are two components. There's the present value of the $10,000 face value of the bond. So we bring up our function, PV. We have a rate of 2.5% for 6 months, 6 semi-annual periods. We're not going to do anything with the payment at this point, and we have a $10,000 face value. So that gives us 86.23, if you allow me to round. And then we do the same thing for the coupon payment. So present value, we've got 0.25, 6 semi-annual periods, $250 payment, no future value, 1377.03. Sum those up, $10,000. But then, as I said, you could also do present value, where you put in the rate, the number of periods, and put in both the payment and the face value. And what Excel will do is value them for you together and come up with the same bond price of 10,000.
I have a strong feeling of déjà vu. Have we seen something like this before?
Yes, this is the exact example I used at the end of the time value of money video. So hopefully it made a lot more sense when you saw it the second time.
So now let's go ahead and do the journal entries. So as we have done before, I've laid out all of the payments across the timeline. We get 10,000 when we issue the bond on January 1st, 2010. Every 6 months we pay $250 coupon payment. The end, we make the last coupon payment plus the principal. So let me throw up the pause sign and try to do the journal entry for when the bond is issued on January 1, 2010. So on this date, we're receiving cash of $10,000, so we debit cash. We credit bonds payable liability of $10,000. Now let's look at the journal entry for the periodic coupon payments, and those 5 payments in the middle are all identical journal entries, so just try to do one of those and it'll apply to all of them. So here is the pause sign. Okay, so we're debiting interest expense for $250 because this is a cost of interest, cost of doing business, goes onto the income statement. And then we credit cash for $250 to represent the cash we pay for the coupon. So we're going to do that for those 5 intermediate 6-month periods. Then the last entry we're going to look at is December 31, 2012, when we have to repay at maturity. So let me one last time throw up the pause sign and try to do this journal entry. Okay, so we're paying off the principal, so we debit bonds payable to reduce the liability by $10,000, so it makes the liability 0. We do one more coupon payment of interest expense, so we debit interest expense for $250, and then credit cash for the $10,250. And of course, you could have also split this into 2 entries: debit interest expense, credit cash for $250 each, debit bonds payable, credit cash for $10,000 each.
This seems very easy. I thought bonds were going to be difficult, so I am kinda disappointed.
Yeah, if only all bonds were this straightforward and easy. Unfortunately, they're not. And in the next video, we will crank up the difficulty when we look at discount bonds, premium bonds, and retirement before maturity. I'll see you then.
See you next video.